Good morning, good afternoon, and good evening to all the participants from the various part of the world. I, Premji Fufal, heartily welcome you all for the 7th season of NRI Financial Conclave 2023. Since several years, our company has tried to educate the NRIs around the world on wisely managing their Indian financial affairs in a systematic way. This year, with a larger and brighter vision in our eyes for India, we have selected the topic of Amrit Kaal for NRIs in India, organized by Ashutosh Financial Services Private Limited. We will be discussing NRI taxation and regulation and NRI investments and insurance, and we have also arranged a panel discussion with the senior executives from HDFC Asset Management Company and Kotak Bank Limited to explore the opportunities for NRIs in GIFT City. The first part of the presentation, which will be on NRI regulation and taxation and NRI investments and insurance, will be covered by Mr. Daxesh Kothari, who is a tax and financial consultant and MD and CEO of our company, along with CPA, along with CA CFP Rajit Kothari, who is an executive director of our company. Before we move on for the core presentation, let us first witness the introductory videos of our company and today's speaker, Mr. Daxesh Kothari and CA Rajit Kothari, after which we can start the core presentation. Kindly post your questions in the chat box, and those questions will be answered by the speaker after the core presentation. Thank you.
Years back, late Mr. Dinesh Kothari started a firm in the name of Messrs. Kothari and Company to provide tax and allied laws advisory services. Later in the year 2001, the activities of the firm got expanded into a corporate entity in the form of Ashutosh Financial Services Private Limited. Over these years, the company has emerged as a prominent player in the field of finance and taxation. The company operates with a quality management system certification of ISO 9001-2015 and is now a complete financial services solutions enterprise. Ashutosh Financial Services Private Limited is presently serving in the fields of investment services, insurance services, NRI services, income tax and estate planning services. Investment services, which is in the activity of connecting people with investment opportunities for Indian markets, mutual funds for equity, debt and hybrid funds, portfolio management services for equity shares, alternative investment funds for listed and unlisted equity shares of unlisted companies, advisory stock portfolios for curated portfolios of equity shares, bonds, that is tax-free bonds, taxable bonds and capital gain bonds, fixed deposits of top-rated corporates, precious metals through sovereign gold bonds, for investing in global markets through mutual funds, equity shares of foreign companies and ETFs, and precious metals through ETFs. Insurance services by the company is provided by Ashutosh Insurance Brokers LLP, which provides insurance solutions for life insurance for life risk coverage, health insurance, mediclaim and personal accident, insurance of assets for all types of risks, insurance for liabilities, retirement and pension planning needs, and investment through insurance for guaranteed returns and ULIPs. NRI Services is a one-stop solution for NRIs to address their needs of investments in mutual funds, PMS, AIFs, unlisted stocks, foreign equities and advisory stock portfolios, insurance for life risk, health, assets and liabilities, retirement planning and investment through life insurance, complete planning and compliance for Indian income tax, advisory under FEMA and RBI regulations, estate planning for Indian assets, and complete support for compliance related to foreign tax laws in respect of Indian incomes and assets. Income tax and estate planning services works as advisory and compliance for income tax, estate planning, endowments and charities. Our company is a unique setup which is truly a one-stop solution for all the financial and taxation needs of the client. The company enjoys a state-of-the-art infrastructure facility having its office in the middle of Rajkot city spread across 4,000 square feet area consisting of separate setup for each division. The company has a fine mix of personnel from financial and legal background like chartered accountants, lawyers, certified financial planner and management graduates to form a dedicated team of skilled and qualified staff. The team works under the dynamic leadership of Mr. Daxesh Kothari, who is the MD and CEO, and Mr. Rajit Kothari, who is the Executive Director of the company. All the divisions and departments manage their operations with high-tech versatile softwares, and the entire IT infrastructure is connected with integrated file server for seamless exchange of data with security and regular data backup facility. The company has a fully equipped conference room with projection and video conferencing facilities, which makes dissemination of knowledge, information and interaction convenient. The company has its offices at Ahmedabad and Mumbai to facilitate the clients. The company website www.ashutoshfinserv.com and mobile application Ashutosh Financial gives an overview of the happenings in the world of finance and is also a useful client user interface. We operate multiple investment management softwares for managing our clients' investments, having interface with our website and mobile app. With the help of our website, reporting software and app, our clients can carry out complete paperless investment transactions and can have access to their investment portfolios on real-time basis. We regularly update our clients with latest happenings from the world of finance and taxation through digital mode of interactions using YouTube videos, WhatsApp broadcasting, social media that is Facebook, Instagram and LinkedIn. The company has been conducting presentation on analysis of the union budget since last 17 years, organizing series of presentations for non-resident Indians on aspects of taxations, regulations and investments since last 5 years, and the company is also arranging presentations for various sectors of economy and society by covering topics of vital importance related to finance, taxation and estate planning. The company serves to more than 3,500 satisfied clients spread across the world and is actively maintaining business relations with many clients and groups for more than 60 years. Ashutosh Financial Services Private Limited is growing as a complete financial solutions enterprise with its presence felt not only in India but also globally. Mr. Daxesh Kothari is a tax and financial consultant and the Managing Director and CEO of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning and foreign tax compliances. On the financial front, he specializes in investment services and insurance services. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the union budget since last 16 years and also on various subjects of taxation and finance at various forums addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretaries, NRI, and postgraduate students of diverse branches on subjects related to finance, taxation, and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc., and also in magazines like The Lal Street. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance, which makes him a unique and truly a one-stop solution provider for wide range of financial and tax-related matters. Mr. Rajit Kothari is the Executive Director of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He is a chartered accountant and a certified financial planner by qualification. Further, he has graduated in the field of commerce with specialization in banking, financial services, and insurance sector from Ahmedabad University, and has also pursued post-graduation in the field of law. He started his journey with Ashutosh Financial Services Private Limited, where he played an instrumental role in functioning of several business development activities of the company. He also played a vital responsibility in the development of exotic product offerings for the company in the alternate investment arena, such as foreign equity and unlisted stocks. Moreover, he was instrumental in the preparation of extensive knowledge database on different topics concerning taxation and finance for the company. Thereafter, he worked with Messrs. Deloitte Haskins and Sells LLP, one of the leading global consulting firms at Mumbai, focusing on tax and regulatory compliance for high net worth resident and non-resident individuals. He is an expressive public speaker and addresses professional forums on diverse topics related to finance as well as other topics of national importance. He has participated in international exchange program as a student and has also attended management development programs across top business schools in India. As a young and dynamic director with a multi-skilled personality, he presently concentrates on exploring innovative business opportunities through geographical expansion, digital proliferation, and concentric diversification of the company.
Over to you, Daxesh sir. Thank you.
Hello, everybody. The topic of presentation today, Amrit Kaal for NRIs in India. Basically, what is Amrit Kaal? Amrit Kaal is that pious, auspicious time and the golden era for any kind of development. When it comes to India, India is now around 75 years into independence, and it is expected, and that is the way the country is working, that in the 100th year of independence, India would no longer be an emerging market, but a developed market. And this is what is coming out with the amount of things and the kind of things which are happening around us. In the year 2020-21, that is 2 years back, the total GDP of our country was 2.67 trillion US dollars. In the year 22-23, it jumped by around $1 trillion in a period of just 1 year. For 2.67 trillion, it took practically 72 years or 73 years to be precise. And for a jump of around 33% in that, it took just 2 years. And the mark of $5 trillion economy is quite reachable and quite in the foreseeable future that the India is looking at. So in the early stages of Amrit Kaal, which is the 25 years from 75 years to 100 years, India is on the path of massive development, which is happening across in every sphere, right from governance to development in infrastructure and every other place where you just have a look around. So it is in this time that not just the Indians who are living in India, but the Indians who are staying outside of India should also participate in this journey of growth of India becoming a developed nation in the 100th year in 2047. Now, when anybody wants to take a major exposure into any country, or rather start an exposure into any country in terms of making meaningful investments or meaningful financial transactions in India, one needs to understand the taxation and the regulatory aspects of it threadbare. So my part of the presentation today would be talking about the taxation and the regulatory part of the way it is going to impact the non-resident Indians. Today, the way I would like to talk and carry out the discussion would be that I have just chosen few of the points of discussion which we normally have with the non-resident Indians, or certain posers that we receive from them, and I would like to address those posers or those points of discussion and roll out in that process the taxation and the regulatory part. The first question which comes up when somebody is making any kind of investment in India is that I want to generate a fixed return for my investments in India. So what would be the regulatory and the taxation aspect on it? The funds of a non-resident Indian are supposed to be in either of the accounts, which is an NRO account or an NRI account. Here I would like to clarify that a non-resident Indian is not supposed to hold a resident Indian account. If he is holding a resident Indian account, it is a violation of the Foreign Exchange Management Act, FEMA, and they should close down those accounts. Now, from the NRO or NRE account, one can place fixed deposits in different kinds of options which are available with the banks. The first and foremost being the NRO deposit. A NRO deposit is a non-repatriable deposit and it is taxable in India. A NRE deposit is repatriable. So repatriation of funds in respect of the deposits which are held in that account can be made outside of India at any time whenever the non-resident wants to transfer it. And the interest on this NRE account is tax-free. The FCNR deposit is repatriable. It can be held in any of the foreign currencies which the non-resident can think of broadly, and in the interest in respect of the FCNR deposits is completely tax-free. Here, I would like to point out that this tax-free interest is the tax-free status in India, but not necessarily in the country in which the non-resident is a tax resident. So interest on NRE deposit or FCNR deposit could be tax-free in India, but it might be taxable, or rather it would be taxable in the country where the non-resident would be a tax resident. The existing balances of an NRO account as such, as I said earlier, is non-repatriable, but under the $1 million scheme of the Reserve Bank of India, any balances of the NRO account can be transferred to NRE account or outside of India by meeting some basic conditions of payment of taxes and carrying out certain formalities with the bank. And by that, a person who is a non-resident can transfer funds to the extent of 1 million US dollar per person per year from the NRE account to the NRO account to the NRE account or outside of India. If a non-resident intends to transfer a money which is in excess of 1 million US dollar, then the NRI should seek a specific permission from the Reserve Bank of India. When it comes to remittances, the sale proceeds of 2 residential houses, if they were bought out of foreign remittances or NRE account balances, can be repatriated outside India over and above this $1 million leeway which is given by the Reserve Bank of India. Then all the current incomes like interest, rent, business income or professional income of a non-resident can be remitted outside India without no limits, and it is not a part of the $1 million limit which I have just narrated. So on the top of that $1 million, one can repatriate sale proceeds of 2 residential houses if they were bought from foreign currency, and also the current incomes which accrue to the non-resident during the year or in earlier years. Then the next point of discussion which comes up is, I want to invest in real estate in India. Now, when somebody wants to invest in real estate in India, the funds can flow from the NRO or NRE account, and they can make investments of whatever residential, commercial, plots of land, any number of plots of land which they might desire. But the restriction is that the non-resident Indian cannot carry out business of real estate, by which I would mean that trading in real estate, buying and selling actively real estate is not something which is allowed to a non-resident. Moreover, investment into any agricultural land by a non-resident Indian is also not allowed. A non-resident Indian can hold agricultural land which he or she was holding before he or she became a non-resident Indian, and they can receive agricultural land by way of inheritance, but they cannot buy any new agricultural land. When it comes to taxation on the sale of real estate, the period to qualify for long-term capital gains is 2 years. If the asset was held for a period of 2 years, then it would be taxed at the rate of 20%, and the rate of TDS, which is the withholding tax, is also 20%. Short-term, which is below 2 years, short-term capital gain is taxed at the slab rates, and the TDS rates is 30%. Now, the amount on which the TDS is supposed to be made by the buyer of the real estate. So the NRI is a seller and maybe a resident Indian is a buyer. So when the payment is made to the NRI, the TDS is subjected on the entire sale consideration, not just the gains on the transaction. If a non-resident Indian wants to avoid that higher amount of TDS, then they should seek a lower tax deduction certificate expressly from the income tax department. It takes a little time of at least 1.5 months, but the entire process is electronic, and it is possible to get a lower tax deduction certificate in case where the transaction is contemplated. When an agricultural land is sold by an NRI, the sale proceeds of the agricultural land are tax-free if in case the agriculture land is situated beyond a specified limit from the borders of a particular town or city with a certain amount of population. So those rules regarding it have been laid down, but the fact is that the agricultural land situated beyond those specified limits are completely tax-free without any limits. Then When it comes to repatriation, as we discussed earlier, sale proceeds of real estate, which are residential properties purchased out of NRE account balances or remittances, can be repatriated to the extent of 2 residential properties, and all the credits of real estate which are credited in the NRO account of a NRI would be eligible for repatriation under the $1 million scheme, as explained by me earlier. Then the next point of discussion is, I want to invest or start a business in India. If a NRI wants to start a business in India, funds can move from his NRO or NRE account, or maybe even remittances from outside of India. The NRI can start business in proprietorship, partnership, but they cannot start any real estate business, nor can they carry out any agricultural activity under the proprietorship or the partnership firm. When it comes to the business being carried out in the LLP or the company format, the NRI can venture into businesses which are under the automatic route of approval. Major businesses, all the businesses other than defense or of some strategic importance, they are under the automatic rule of approval by the government, and only a few are under the approval route rather than the automatic approval route. So a non-resident has got far and wide choice of starting businesses in India. All the entities under which the NRI is doing business in India is liable to taxation on the basis of the Indian tax rates. The incomes which are distributed by those respective entities to the NRIs are subjected to taxation in India, and the income which is distributed is also subjected to TDS on the incomes which are paid to the NRIs, and in most of the cases, they would attract a TDS of 30% plus surcharge plus cess, which is the specified rate. The proceeds which are received back from the business could be repatriable if the funds which are invested in the business and the formalities in respect of that are carried out, which are originating, say, from the NRE account or from the remittances outside India. Then the monies which are returned back from the business also become repatriable. And if in case, if they are invested from the NRO account balances, they are as such non-repatriable, but they can be remitted under the $1 million scheme, which I explained earlier. Then the another point of discussion is, I want to invest in shares or PMS, portfolio management services, in India. So in this case, monies can flow from the NRE or NRO account into the NRE PIS account, where the investments would be on a repatriable basis, because that portfolio investment scheme account, PIS account, is a repatriable account and which is mapped up with the NRE account. One can make investments on a non-repatriable basis by opening a demat account and mapping up with the NRO account. The sale proceeds are taxable in the manner that if those investments of shares held directly by the NRI or through the PMS route are held for a period of more than 1 year's time, then they are taxed at a rate of 10%. And if they are held for a period which is shorter than 1 year, then they are taxed as short-term capital gain at the rate of 15%. The gains, long-term gains to the extent of 1 lakh, are exempt in the hands of non-NRIs. The dividends would be taxable at 20%, and one of the concessions which normally very few NRI avail of is that if in case, if a non-resident has invested in shares of Indian companies, and if there is a long-term capital gain and the original investment of those shares is made out of NRE account or remittances from outside of India, they qualify for exemption under section 115 capital F, where the amount which is the sale proceed of those shares, if they are reinvested for a period of 3 years in specified assets. Specified assets include shares of other companies and also bank deposits, then the entire capital gain in that transaction would be completely tax-free. Now, when it comes to repatriation of funds, the repatriation of funds would depend upon whether the funds originally at the time of investment have originated from the NRE account, which is a repatriable account, or an NRO account, which is a non-repatriable account. Once again, I would remind that if there are proceeds in the NRO account, they qualify for remittance under the $1 million scheme, which we have been talking of. I want to invest in Indian mutual funds, and that too equity-oriented mutual funds and alternate investment funds. Now, here also the monies can flow from the NRO or NRE account into these investments, and the taxation of these investments would happen only on redemption of these investments. Till the time they are held and there is no redemption which is happening, till whatever period they are held, they would not attract any taxation in India. Now, when those investments are divested, if the equity-oriented mutual funds or AIFs which are holding listed equity shares are divested, then the period of holding, as it is in the case of shares, listed shares, is 1 year. The same applies here, and they would be taxed at the rate of 10%. And if it is held for a period, the asset is held or the investment is held for a period of less than 1 year, then they would be taxed at 15%. The dividends would be taxed at 20%, and the gains to the extent of 1 lakh in respect of gains, long-term gains on equity mutual funds would be exempt. And when it comes to Cat 3 AIF, which is category 3 AIF, the entire taxation of capital gains, business income, everything happens at the fund level, and the non-resident Indian, or for that matter, any investor who is investing into Cat 3 AIF is not supposed to pay any taxes, and all the tax-related compliances and payment is done at the fund level. Now, when the repatriation is to be taken into consideration, it all depends upon the origin of funds. If they are from the NRE account, they are repatriable. From the NRO account, then they are non-repatriable. Now, let us look at some other aspects as well beyond these investments or transactions of or financial transactions which we discussed. Now, let us understand the laws governing non-resident Indians in India. As far as India is concerned, the Income Tax Act is the first and foremost law which would judge as to somebody is a resident or a non-resident. The basis of determination is the number of days of stay by that person in India. And it is strictly on the basis of number of days of stay that the determination of somebody being a resident or a non-resident will be determined. And that would impact the taxability of Indian income and foreign income in India. Then the another law which one needs to take into consideration is the Foreign Exchange Management Act. Under this law, the number of days of stay in India is definitely important, but over and above, what is important is the conduct and the intention of the person who is in India. So, over and above the number of days, even these aspects are taken into consideration in order to determine whether somebody is a resident or a non-resident under FEMA. The law would be significant from the standpoint that banking and investments in India would be governed by the laws or the provisions of FEMA, and somebody who is a resident or a non-resident would make the banking and investments for them quite different in each of the cases. The third law is the Citizenship Act. The Citizenship Act is which country you are a citizen of. which country you are holding the passport. India does not allow dual citizenship. If somebody is holding an Indian passport, they cannot hold any other passport simultaneously at any point of time. The OCI benefit, the Overseas Citizen of India benefit, is just a benefit which gives certain concessions to persons of Indian origin by making them overseas citizen of India, which give them certain privileges in investments and traveling to India without any visa. But the fact is that that person who is an OCI does not enjoy the fundamental rights as a citizen of the country. They enjoy certain limited rights which are governed or which are allowed as an OCI card holder. Then another question which very commonly comes to us is that do I need to disclose my Indian income in my country of residence or not? The answer is very much a yes. The way the taxation happens is that any income which is sourced from any country in the world, those incomes would be subjected to taxation by the country in which those incomes are sourced from. So if there is an income which is arising from India, India would say that we provided you the facility of earning this income, and we would tax the incomes which have arisen out of India under the principle that you have sourced this income from India. Now, the another principle is the residence rule, which would say that any person who is a tax resident of a particular jurisdiction needs to offer to tax in the country where he is a resident the entire income, which includes the income which is generated in that country, and over and above that, the income which has been sourced from any part of the world. So, the income which has already been taxed from on the source basis in different countries of the world have also to be offered to tax in the country where somebody is a tax resident. So the obvious question which comes up in anybody's mind is that, would I be taxed doubly on the same income? The answer is that there are double taxation avoidance agreements between jurisdictions. And when it comes to India, India has got DTAA signed with 94, which are all the major economies of the world. And under that, whatever are the incomes which are taxed in India, they would be subjected to taxation in the country where that person is a resident. But the person who is taxed in the country of residence would get a relief. So in most of the cases, what would happen is that the income sourced from India would be offered to tax in the country of residence, and from whatever taxes which are due in the country of residence, there would be a deduction in respect of taxes which have already been paid in India. So effectively, the incomes would not be doubly taxed. One of the questions which commonly come up, especially in case where somebody is a US green card holder. Here, in case somebody is a US green card holder, what happens is that anybody who is a US green card holder or a US passport holder, means a US citizen, that person is mandatorily a US tax resident no matter wherever he or she resides and for whatever number of days. So we come across to people who would be holding green card or citizenship, but they would be residing for major part of the year in India. So what happens is, on the basis of whatever we have discussed earlier, India would say that because you are staying for large number of days, that threshold number of days, we will make you a tax resident of India. While as the US would say, because you are a green card holder or citizen of US, you are mandatorily our US tax resident. So what happens is that that person becomes simultaneously a tax resident of India and US both at the same time. So now this DTAAs come into operation. Under the double taxation avoidance agreement between India and US, there is a tiebreaker rule. So these tests have to be applied, wherein the first test is that which is the place of permanent home. Then if in case if it is somebody has got home at both the places, then the next test which is to be applied is the center of vital interest, and further on there are several other tests further on down which can be applied and determined, which can be used to determine that which country this person would be a tax resident of. The moment any of this tiebreaker rule becomes clear and applicable in a particular case, then we need not go any further. And on the basis of that, the kind of compliance which one is supposed to carry out in the US and India is of a very different type, and the taxability of income also happens on the basis of those provisions under the DTAA. In the slide before you, we have placed the details as to what are the compliances which somebody is supposed to carry out in those situations. Then another question, especially when it comes to the US investors, is that are we supposed to pay taxes on sale or redemption in the US or at any time which is before that? So the answer is that when it normally the principle of taxation is that the taxation arises only when there is an incidence of capital gain on transfer or redemption. But when it comes to the US and in case of mutual funds and AIFs, the provision of which has been in operation in the US is a passive foreign investment company PFIC provision, under which the notional appreciation of the mutual fund or the AIF will be subjected to tax at the end of every year. So whatever was the value of the mutual fund or the AIF at the start of the year, that is 1st of January, and the valuation as on 31st of December, whatever is the difference will have to be offered to tax at the end of the year, despite the fact that there is no redemption or sale of any units which are happening in that particular year. Then one question which is up in the minds and of the non-residents is that how can I mitigate the anomaly arising out of different accounting years between different jurisdictions for the disclosure of my incomes and assets? Because, say, for instance, when it comes to India, the financial year is 1st of April and 31st of March. This is the year on the basis of which taxes have to be paid, filings on the taxation side have to be done on that basis, and this is the way the entire financial year works in India. But when it comes to the US, it is from 1st of January to 31st of December. So there are different tax years in different jurisdictions, and in that scenario, how can a non-resident mitigate that anomaly? The simplest process which we advise and which we carry out in respect of so many of our clients by managing their financial affairs in India is that we segregate their transactions from 1st of January to 31st of December from the bank statements or the investment statements. And if in case if there are several transactions, then what one can do is that one can punch in those transactions in a computerized accounting software, and one can put a start date which could be the date according to which the reports are required, and end date also on the basis of the period for which the reports are required. And on the basis of that start and end date, one would be clear about the income which is to be aggregated in that particular jurisdiction. When it comes to the tax credit, which is available under the DTAA, as we have discussed earlier, is that the incomes to be offered to tax in the US, for instance, would be from 1st of January to 31st of December. So now whatever taxes have been paid in respect of that particular period are available for credit. So for the period starting from 1st of January to 31st of March, the taxes would have already been determined because the Indian year would have ended on 31st of March. So the real taxes which have already been paid, actual taxes on the basis of calculation in the return filed, would be the ones which will qualify for deduction under DTAA while filing US tax returns. But when it comes to the period starting from 1st of April and 31st of December, the year in India is still on. So whatever is the TDS and the advance tax which have been paid in respect of that income, and which is the amount of tax which is due on that income, will be the amount which would be calculated, and that would be the amount which the NRI would be able to take credit of while filing the tax returns in the US or any other jurisdiction. So the data which is to be supplied for US tax compliance would be the incomes date-wise and the respective financial year, the name and address of the source of income, and it has to be converted into that respective foreign currency, which is in case of US would be naturally the US dollar, the TDS withholding tax, and the prepaid taxes, which is the advance tax, and final tax liability would be the one which would be on the basis of the prepaid taxes and the taxes which have already been paid, which can be claimed as a credit by filing the US tax returns. The further data which would normally be required by several jurisdictions will be in respect of the assets which are held by the NRI in India, and especially the financial assets which require a special declaration and a special presentation under the several regulations in several jurisdictions, and especially in the US, and the details of investments in that respective foreign currency, and the closing balance of mutual funds in the respective format. Then one question which is very much up in the minds of all the non-resident Indians is that, is an NRI required to file income tax returns every year if PAN is obtained in India? Because they feel that if I have obtained a PAN, then would I be subjected to or thrust upon a liability of filing my tax returns in India? The answer is that one need not be mandatorily filing tax returns in India just for the reason that you are holding a PAN number. PAN is just a tax identification number, which is the registration for that particular SSE or that particular person in India. But the return is to be filed only in the circumstances as which has been detailed in this slide, where the income exceeds 2.5 lakhs in India before giving effect to certain deductions which have been specified. Then somebody wants to claim a refund, somebody wants to claim any loss or carry forward of loss, or if the person falls into any of the categories, which are 7 different categories where different kinds of transactions have been carried out, and which would include depositing a certain amount of money in the bank account, transactions relating to some sales, gross receipts, or maybe a tax deduction at source, maybe an electric expenditure, expenditure on electricity, or maybe a travel from that bank account outside of India. So if somebody is holding a bank account in India, and if somebody has incurred an expenditure in excess of 2 lakhs of rupees on a travel out of India, then in those scenarios, one would be required to file tax returns in India. Otherwise, making any amount of investments, but if there is not a scenario or a situation where one would fall in any of these cases which we have detailed out, then that person is not supposed to or is not required to file tax returns in India. Now, the question which comes up in minds of non-residents who have got quite exposure of financial assets and investments in India is that, are there any ways and means by which somebody can lawfully plan their tax affairs in India? Yes, very much. One can plan tax affairs lawfully in India. And here are certain different ways by which one can legitimately reduce their tax liability by making some lawful planning. There are certain deductions under Section 80C, 80D, 80G. 80C is for certain investment, 80D is for some health insurance, 80G is for donation, and the deduction under Section 80TTA is for the interest which is received on the NRO account for a certain amount of money. Then if NRI has bought any property in India by availing any loan, the interest amount on those loans is also deductible within a certain frame of deductions. Then this is something, now this planning is something which is quite very much important. If an NRI is intending to stay in India for a long period of time, then ideally they can and they should plan their their stay in India in the manner that their stay is split across 2 financial years. So when it comes to the way Income Tax Act calculates the number of days of stay in India is on the basis of 1st of April to 31st of March, which is the financial year in India, and the number of days of stay on which is in that particular financial year. So if one wants to stay for a longish period of time, one can split their stay across 2 financial years and thereby avoid being a tax resident of India and continue enjoying the non-resident status. Say when there is any incidence of capital gain, then there are certain deductions from the capital gains, and those deductions can be availed by investing in bonds, investing in residential houses, and the deductions are available on the basis of the investment which is made and on the basis of the capital gains which is accruing or arising on the transaction of that capital gain. Say gifts from one person to another in India between relatives which have been specified out in the slide is completely tax-free to any amount. So one can make a simple planning by which, say, I want to reduce my tax liability in India on account of the incomes which I generate out of my investments in India. So what I can simply do is that I can gift a certain amount of money to my son who would receive that gift, and because of the relationship between father and son, which is a defined relationship under Section 56(2), the transaction does not attract any taxation, and that capital which is received or gift which is received by my son would help him generate his own income, by which tax planning is possible. Then planning can be done to manage the tax affairs by virtue of by executing a will, and amounts received by virtue of inheritance or under a will are completely tax-free, and amounts received on the occasion of marriage are also completely tax-free. Say, remitting money to India is completely tax-free. So if there is a remittance received from outside of India in my account, if I am an NRI, then they are completely tax-free. But if there is an income which is directly received in my account from outside of India, then that income which comes to India directly, otherwise than by way of remittance, becomes taxable in India. So the ideal planning is that one should receive those monies outside India in those accounts which are held outside India, and then bring those monies to India by way of a remittance. Then all these deductions which we have been discussing and talking, which is interest on NRE accounts, or maybe on maturity of insurance policies or capital gain exemptions, but all these incomes which are exempted or deductible in India are limited to the Indian law, and they could be taxable in the country of residence in which the NRI is based. Another planning which can be done is that if there is an interest income from an NRO account, which is a taxable account, the balances of the NRO account can be transferred to NRE account or FCNR account, which are tax-free accounts. India allows a creation of an entity under the Income Tax Act, which is a separate legal entity, which is a Hindu undivided family entity, which can be used as a means of planning the tax affairs in India in a legitimate and a judicious way. So many of our non-resident Indians have left India before 15 years, 20 years, or maybe much, much more. So it is up in their mind that the tax system in India and the administration of the tax system in India is quite bureaucratic, and it is something which is quite cumbersome. But the fact since last 2-3 years is quite very different. The entire filing of all returns, forms, every other kind of filing and communication with the Indian income tax authorities is completely faceless. All the assessments, appeals are also completely faceless, and all the transactions of the NRI are completely mapped with the permanent account number. There is no scope of any personal interaction with any official or anybody. All representations have to be made through the digital mode, and all submissions have to be made through the digital mode, and that entire process is completely faceless. This is a major landmark change which has happened in India, and the parallel economy which so many of non-residents and residents saw it to be quite very painful is now cashless and more compliant economy, and it is an economy which is more generating larger amount of revenues, which is at times much more than what is even the budgeted revenues on the direct taxes side. When it comes to the transmission of assets, the common question which is being asked to us is that whether the laws of transmission that would be applicable in case of death of an investor would be the ones which are from the country where that investor or the non-resident belongs to. Say a non-resident is a citizen, a passport holder of some country which is a non-Indian country, and the investments are in India. So in respect of the Indian investments, which laws of transmission or succession would apply? The answer is that in respect of the Indian assets may it be movable or immovable, the laws of succession would, in India, would apply on those assets, and the succession would happen in accordance with those laws. Now, there is also a question which comes up is that what will be the position if somebody dies without executing a will or dies after executing a will? So when somebody dies without executing a will, then that succession is called an intestate succession. An intestate succession would happen in accordance with the laws which are prevalent in respect of the particular community that person belonged to. If the person who is deceased is a Hindu, then Hindu Succession Act would be applicable, and all those who are defined as the legal heirs under the Hindu Succession Act will have the right to get the benefits or right of bequest in respect of the properties of the deceased. But if in case in India, if somebody executes a valid will, then it is called a testamentary succession, and under the testamentary succession, the Indian Succession Act states that all the provisions of the respective laws of intestate succession, which is in case of a Hindu Succession Act, will get superseded, and whatever has been provided in terms of succession under the will to whom these assets would be bequeathed is that which would stand. One discussion which comes up with us very often is that, say, if in case I am holding financial assets in India, and if I have made nominations in all my assets, is that good enough to take care of the succession? Here, the position of law is a nominee or a joint holder is merely a custodian. He gets the custody of the assets, and the financial institution which is holding that financial assets duly discharges its duty by handing over the possession of that particular financial asset to the nominee or the joint account holder. But the real owner of that asset would be the person who is the heir under the Hindu Succession Act in case of an intestate succession, or the person who is the beneficiary under the will in case of a testamentary succession. Does a NRI need to be in India to execute a valid will? So after whatever we have been discussing, one would feel that it is important to execute a will in India in respect of the investments that somebody has already made. So yes, it is very important, but the question which comes up, as I said, is that should I wait for the time when I am in India to execute the will? The answer is that wills can be prepared and executed anywhere in the world in respect of the assets which are held in India, and the wills can be signed, executed by the testator, the person who is preparing or rather declaring his will. It needs to be witnessed, and what we advise is that if it is executed outside of India and even in India, it is always better to be signed before a notary public, and even the declarations of the witnesses who have signed as witnesses also be taken in before the notary public, so that it does not create any doubt. So this was all from my side on the taxation and the regulatory part for all of you to wholeheartedly participate without any reservations in the Amrit Kaal of India. Thank you.
Well, thank you, Dakshesh sir, for giving us a wonderful insight on the NRI investments and regulations, NRI taxation and regulations. Now, CA Rajit Kothari will take his part of the presentation, which is based on the NRI investments and insurance. Thank you.
Hello everyone. Welcome to our seventh conclave organized for NRIs. In this interesting topic of Amrit Kaal, which is the golden era and the opportunities that this era offers for NRIs. In the first part, we looked at the surrounding ecosystem which someone has to look into while participating in this Amrit Kaal, which is the taxation and regulatory implications. In this session, which is the second part of our event, we'll be discussing as to how can actually one participate in this Amrit Kaal by way of investing and by way of insurance in India. The entire session is going to be divided into three parts. The first part being as to why are we claiming to be in the Amrit Kaal movement as of now. The second part being how can someone participate in this Amrit Kaal movement? And the third part being how can someone successfully navigate and emerge out of this Amrit Kaal? Starting with the first part as to why are we at the cusp of this Amrit Kaal and why is it this the beginning of the Amrit Kaal movement? The foremost reason is the growth of the Indian economy. The Indian economy has been the fastest growing economy amongst the top 20 economies since a few years now. The recent RBI projections have forecasted a growth which is even greater than what is mentioned in this slide, which is of 7%. And if our country continues to grow at this rate, if the GDP of the nation continues to grow at a 7% plus rate and also double digit in the coming few years, the entire face of the Indian economy would change in a very substantial manner. Interest rates are also a very important barometer to identify the macroeconomic stability of any country. If we compare the interest rates of the central bank announced by the central bank as compared to last year with this year, we can see that the interest rates are by and large stable and there hasn't been much change in the interest rate, which is a very positive sign because it gives some kind of clarity and visibility to all the investors and the every participant of the economy. Similarly, when we look at the stock market performance of the top 20 economies, we can see that the Indian stock market, which is Sensex, the index, which is Sensex, has grown by about 12 to 13%. If we compare it with other emerging market, which is China, and the most commonly compared economy with India, then there is a sharp outperformance as compared to the Chinese stock market. If we compare this with Russia, there has been a greater amount of outperformance in the Russian stock market, but this is on account of the low base and the sharp correction that the Russian stock market had observed in the last few years on account of the geopolitical tensions. One interesting fact to notice is the exceedingly well performance of Indian small cap and mid cap indices, which are outstanding. With this highlights the kind of opportunities which lie in all the small cap and mid cap companies in India to multiply their earnings and generate these kinds of extraordinary returns in the times to come. The depreciation of currency is a very commonly observed phenomena since last several years vis-a-vis the currencies of the developed economies, especially the US dollar. If we compare the depreciation of our currency in the last 1 year, then it has depreciated by a meager 2 to 3%, which is also a very positive indication and shows the stability and the strength of Indian rupee. Now let us understand in depth as to what are the actual drivers of this Amrit Kaal. First and the most important is the demography. The thriving 1.5 billion population of India, which is nearly that of China and soon going to surpass China to become the largest population in the entire world. This gives a lot of scope of demand in the entire country because of this huge population. And interestingly, majority of this population is young, comprising of Gen Zs and millennials like me, who are very well talented and equipped to take our country to the next level. Looking at the democratic governance, we can observe that the Indian government has been quite strong and stable in the last few years. The advantage of this is that it can ensure stability of and continuity of policy, and enforcement of whatever directives are laid by the government is something which we can very well expect and predict because of this. Needless to say, the tax reforms, may it be the direct tax or indirect tax, have been path breaking. We are crossing and surpassing month on month records for the kind of tax collections that are being generated through income tax as well as GST. Also, the policies that are being framed to promote businesses are quite friendly, and that is why the ranking of India in the ease of doing business has improved sharply. For the first time ever, or after a very long time, the actual tax collections have been greater than the budgeted estimates, which is an extremely positive sign. If we look at the capital markets, then they are being respected right now for their efficiencies as well as the transparency. The regulator of capital markets is being recognized across the world for its decisive policy and taking different measures and initiatives to protect the investor of India. Since several years, we have always observed and criticized the public sector enterprises for their inefficiencies and lethargic ways of working. Since last a few years, the public sector enterprises have seen a sharp improvement in terms of its productivity, independence, as well as efficiencies, which have not just resulted into increase of their earnings as well as revenues, but have also sharply increased their market capitalization in the stock market by lakhs of crores. This is a very positive indication for our economy. The agility with which the Reserve Bank of India has been announcing different policies of late, especially by curbing the slightest of the crisis, is something which is very commendable and has helped our economy to sail through all different kinds of anticipated crises that someone could foresee. The present geopolitical might of India is at next level, considering the kind of diplomatic relations that it shares with the major superpowers of the world. This is why it can channelize all these relations to its own economic interest. Just to give you an example, India could procure cheap oil from Russia despite of sharing good relations with US at the same time because of its good geopolitical relations. Digitalization and financialization of the economy. The UPI transactions in India are the highest in the entire world, with the second largest internet user base. This entire cult of financialization has been so phenomenal that the savings pumped in by the DIIs are increasing that which are pumped by the FIIs. All these years, the Indian economy was extremely dependent upon foreign inflows, the trend of which is now changing, and the domestic investors have started realizing the importance of investing into financial assets, which is why a lot of financialization is taking place. If we look at the consumption, a per capita income of India has crossed $2,000 mark, which is why India is becoming the fastest growing consumer market in the world. And the entire consumption theme is shifting from necessity based consumption to discretionary consumption in the coming times. Also, another interesting fact to notice is that this consumption, a large part of it is shifting from the unorganized to organized players, which ensures the entire business cycle running in the organized channel, so that the entire investment, whatever happens, is in the organized channel as compared to the unorganized channel, which was earlier. The infrastructure, which we can very well observe around us, is developing by leaps and bounds. The remotest locations of India, which were always neglected all these years, are now getting better and better road connectivity, railway, as well as different airports and ports. Interestingly, the road network of India might be the largest in the world in the coming times if the entire infrastructure build-up happens according to what has been planned. Manufacturing is another important theme that has recently picked up in India, especially due to the disturbance of the geopolitical tensions with China, with the rest of the world. Also, several other important government policies, such as the Atmanirbhar Bharat, production linked incentive schemes, are something which have driven the exports to a staggering of $450 billion. Because of all these initiatives, the private sector is getting motivated to invest more and more into plant and machinery and all kinds of capital expenditure, which is kickstarting the entire economy, and that too with a very healthy balance sheet. We very well learned, and the fact that India is in the Amrit Kaal movement is a very undoubted kind of a fact. But now let us look into the aspect that how can an NRI participate in this Amrit Kaal movement. The most simple, convenient, and the cost-effective manner of participating in this Amrit Kaal movement is through investing into equity-oriented mutual funds. The entire nation has now accepted this avenue of investing, which is why the mutual fund industry AUM, that is the assets under management, have recently crossed a 50 lakh crore mark, rupees 50 lakh crore mark. However, what we have always observed all these years is that several investors invest in these mutual funds on a random basis by investing haphazardly or through participating in NFOs, that is new fund offerings of mutual funds, without any kind of proper calibration. The ideal way of going about it is to build a well-designed portfolio, keeping in mind all these important aspects that we have mentioned, which is the financial profile of the investor, the risk appetite, as well as the financial goals. Also, it is important to include all these different categories of schemes, since each one of them has a different role to play in the growth of the portfolio, which is large and mid, flexi, multi, so on and so forth. Another important aspects to note while building a mutual fund portfolio is the concentration of different mutual funds or asset management companies, the quartile performance, as well as the comparison with the relevant benchmark that the particular mutual fund is following. Another avenue of participating in this Amrit Kaal is through investing into a portfolio management service. This EMS is basically a bunch of diversified stocks managed by a qualified fund manager who has got relevant expertise in this field. Talking about the advantages of investing in a PMS from the NRI standpoint is number one, that there is no notional tax in USA. As we discussed in the earlier part of the presentation, that if a US tax resident invests into Indian mutual funds, irrespective of whether those gains are realized, the investor is supposed to pay taxes on a notional basis. As compared to that, a PMS, as the investor investing into a PMS is only required to pay taxes on the number of transactions that are executed during the year and the gains that are realized, and not on the entire notional gain which is yet not realized. The second advantage of investing in a PMS is that the fund inflows and outflows of other investors does not impact the particular PMS portfolio of the investor. This is because every PMS portfolio has a unique demat account and separate bunch of stocks. So if there are inflows and outflows from other investors, may it be through redemptions or fresh inflows of investments, it does not have any kind of impact on that particular segregated PMS portfolio of the investor. Thirdly, the regulatory caps or the regulatory restrictions in terms of fund management in a PMS are quite minimal as compared to a mutual fund in terms of sector specific caps or stock specific caps which are there in a mutual fund. Hence, the fund manager has got a greater amount of options and a greater concentration that he or she can play while building a PMS portfolio. The minimum ticket size of a PMS is 50 lakhs of rupees as per the regulatory requirement. The third avenue of participating in this Amrit Kaal is by investing into stocks that are not listed on the stock exchange, which are the unlisted stocks. The rationale for investing into unlisted stocks is quite simple and easy to understand, is to catch them young, to take the early mover advantage. The entire story of this unlisted stock is not available to the public at large, which is why it is available at a very attractive valuation. And someone can attain multi-bagger returns in this unlisted stock because of this kind of a valuation that is available for investment in these unlisted stocks. It is very obvious that once the unlisted stock comes for the IPO and goes for listing, the success story of it would be evident to the world at large, which would be factored in the price, and there would be no further juice left to generate this kind of a multi-bagger return. There are several unlisted stocks available in India today, probably hundreds of unlisted stocks. However, these factors are very important to be kept in mind by selecting the unlisted stocks which we invest. First is the promoter. The background of the promoter is extremely important. Preferably, the promoter should be a conglomerate or should have relevant expertise in this business domain. Second is the track record. The company should have an effective track record of successfully conducting the business for several years. Of course, the business activity should be futuristic. The segment should be a sunrise segment, a new generation idea, and should not be a dated and a sunset kind of a industry or a segment. The business should have some kind of a competitive advantage over its peers, which will ensure greater earnings in the times to come. Also, it is important that there should be a possibility of the company going for an IPO in the near future, so that there is this option of unlocking which the investor can take. And last but not the least, there should be comfort in longer holding period. In case if the company delays its plans of IPO, then the horizon should be such that the plan of the investor should not get affected on account of this greater amount of time period that one has to wait for the IPO. I would like to discuss a success story of one of the unlisted stock, which is Tata Technologies Limited. We have been advising our investors, our clients, to invest in this stock since last 2 to 3 years. If an investor had invested only one share in February 2021 at a price of 1,575, that would have resulted into a valuation of 11,920 as on today. This is because the company went for a bonus issue in January, followed by a split, and announced a IPO last month. Through this entire journey, the current price has reached this level of 1192, which is why the entire investment in one share of 1575, nearly 3 years back, has resulted in a valuation of 11,920 rupees, which is a staggering 7x and nearly 104% compounded growth. This is the kind of massive opportunity that is there in the unlisted stocks. There are several such unlisted stocks that are available for investment today. Few of them being the National Stock Exchange of India Limited, which is truly a monopolistic business and amongst the most profitable stock exchanges in the entire world. Tata Capital Limited, which is another Tata Group company and amongst the largest NBFCs in the country. SBI Mutual Fund, which is the largest asset management company in terms of assets under management, and two HDFC Group companies which are also quite recognized, which is HDB Financial Services, which is the NBFC, and the broking arm of HDFC Group, which is HDFC Securities. There are two challenges which we encounter that every investor faces and has in mind whenever one looks for investing into unlisted stocks. Number one being the selection of stocks, which unlisted companies to invest in. And number two being the price for investing into these unlisted stocks. This is because the investing into unlisted stocks is a quite complicated topic because it involves details about its business, future, promoters, which is not available widely to the public at large as it is available in the listed space. Similarly, as far as the price is concerned, it is very difficult and challenging to ascribe a valuation to that particular unlisted stock because it is not currently listed and several of its financial information is not there in the public domain. The answer to this is through investing into an alternative investment fund which invests into unlisted stocks. This AIF is a structured way of investing into unlisted stocks and is managed by a fund manager who is highly experienced and is well connected in the entire industry. This AIF has, this fund management team has got the relevant expertise to not just pick and choose the right quality unlisted stocks in all different stages, may it be early stage startups, mid stage companies, or late stage pre-IPO companies, but they also have the expertise through several valuation techniques to identify the correct valuation to invest in these unlisted stocks. The minimum amount of investment as per regulatory requirement in AIFs is 1 CR, which is payable in tranches in case of this particular AIF, these kinds of AIFs, and the entire investment cycle, right from investment to return of the investment or the unlocking, ranges from 5 to 7 years. There are other avenues of investing in through a AIF route as well, which are investing in the listed stock based AIF. The advantage of investing into this kind of a AIF is that the entire taxation and compliance burden of investment is the responsibility of the AIF and not the investor, just as a mutual fund. So what happens is that the investor need not bother about filing of reporting the taxes, paying appropriate taxes, carrying out the compliances. Everything of this type is taken care by the AIF itself. Another interesting option of investing into AIF is through real estate debt, which has gained a lot of popularity in the recent times. This is a structured way of investing into debt-based options, which is these funds are invested or these funds are used for financing several marquee real estate projects, which are managed by several reputed builders across the country. The targeted return in these kinds of debt-based cash flow financing projects is up to the extent of 21% XIRR across a span of few years. The entire investment journey in this kind of avenue could last from 6 to 8 years, right from investment to return of the investment. Unit-linked insurance plan is also a very popular means of combination of availing the combination of investments along with life insurance. These investment options can be of several different choices and categories, which comprises of equity as well as debt. Also, the life insurance cover, which can be availed out of this ULIP, is very attractive, cost effective, and if these ULIP policies are held for long tenures, then the entire premium, the cost of life insurance is repaid back to the investor. It is a very big advantage. It works similar to a mutual fund wherein the investor is allotted units for the kind of premiums that it is paid at the respective NAVs. Looking at the taxation viewpoint, the advantage is that there is no capital gains on internal switching of funds from one category to another in the ULIP plan, and also the entire gain arising out of sale of units of this ULIP to the investor is tax free if the annual premium does not exceed rupees 2.5 lakh rupees per individual. Many non-resident Indians want to invest in India but do not want to expose themselves to the foreign currency fluctuation risk, meaning they intend and prefer to invest into their residence country currency, which could be US dollars or GBP or AUD or whatsoever. There is an option of foreign currency non-resident deposits, which is available with the bank, which is a foreign currency denominated deposit. The minimum tenure of it is 1 year, and the entire interest arising out of it is tax free. The strategy that we suggest the investors to adopt for placing FCNR deposits is through borrowing against these deposits, so that these funds, the borrowings against the FCNR deposits, can be invested into growth oriented options, which could be through the equity market or through some other commercial vehicle. So both the objectives are taken care, which is investing into parking the money in the foreign currency and not exposing to the foreign currency fluctuation risk, and secondly, investing into growth oriented assets, so that there is a wealth creation that happens over time. Guaranteed return insurance plans are also wonderful strategies to attain targeted amounts for targeted goals, which could be some kind of a children's education or retirement or any other future financial goal someone can think of. The way it works is that there are pre-calibrated installments of 5, 10, 15 on an annual basis, in which the investor is required to pay the premiums, and the entire return back of these maturity proceeds in form of maturity proceeds happens as per the choice of the investor, depending upon the kind of arrangement that he is comfortable with. This entire arrangement can generate a IRR of greater than 6%, and which is absolutely tax free if the amount of annual premium does not exceed 5 lakh of rupees. Over and above that, life insurance cover is something that someone can get complimentary out of this kind of a policy, and also deduction up to rupees 1.5 lakhs of rupees can be availed on through section 80C by paying premium for these kinds of policies. Many NRIs always dream of retiring back in their motherland India, where they have got several fond memories of their formative years. To fulfill this dream, it is very important to create a retirement corpus in India right from the time when the wealth accumulation takes place for the NRI. There are two popular means of preparing for this retirement, which is number one, through a fixed income route, which is by way of several pension plans that are offered by several insurance companies in India for NRIs, which offer guaranteed linear return across a very long tenure, along with a life insurance cover and flexibility of arrangement in terms of the choice of that particular person. Another important route is through equity oriented option, wherein an investor during the accumulation phase can keep investing and building this retirement corpus through a SIP, that is systematic investment plan, or lump sum investment route, and can withdraw this amount in through systematic withdrawal plan route. The advantages of this strategy is that number one, this ensures tax efficiency, since there is an annual exemption of rupees 1 lakh of gains that is available to every investor. Number two, it ensures flexibility of cash flows, so that this amount of the withdrawal can be changed depending upon the changing lifestyle and the choice of the investor. And number three, the balance corpus, which lies as the retirement corpus can keep growing and is not stagnated as compared to a fixed income investment option. We learned that India is right now at the cusp of the Amrit Kaal movement, and also looked at several ways by which an NRI can participate in this Amrit Kaal movement. Now let us look into practical experiences that we have encountered with NRIs, so that the particular NRI can emerge out successful of this Amrit Kaal journey. A very popular question that we always face from most of the NRIs is, should NRIs always invest in Indian real estate? Many of the NRIs as well as people living in India are of the belief that real estate is a very useful and a popular means of investment. Yes, we agree to that, but there are several challenges which an NRI faces while investing into real estate. So it is important to bear these in mind as well. Number one is the liquidity and management of real estate. Real estate, as we know, are illiquid assets, so it might become a challenge to liquidate it at the time when the funds are required. Secondly, the entire process of investment, disinvestment, and remittance requires a lot of time and effort to carry out the entire activity. It is all possible, which we discussed in the earlier part of the presentation, but the only thing is that there is a lot of time and efforts which need to be invested into it. Thirdly, we very well know that most of the NRIs are quite sure that their next generation is not intending to relocate to India. So it becomes, it may not be a good idea to leave all these affairs in the next generation for them to sort out the entire liquidation and the entire procedure of utilizing this real estate investments. The only way and the only avenue when someone should look at investing into real estate, according to us, is when the real estate property is to be used by that particular NRI. Hence, we feel that financial assets are better options as compared to real estate for investments in India. Now, how should an NRI evaluate the returns that is generated from the portfolio in India? We very well know that whatever investment returns are generated will be subject to taxation in India as well as in the country of residence, as we discussed in the earlier part of the presentation. However, tax credit will also be available for the taxes that are paid in India in the residence country, so there is no double taxation. But the advantage is that there is a flat rate of tax in India for most of the financial investments, and someone, while evaluating the investment returns, should look at the post-tax investment returns and compare it with the post-tax returns available in the home country or the residence country, and then take a call as to which is the correct way of going about it. The advantage of investing in India is that the pre-tax return, the gross return that someone can expect out of the Indian markets is so attractive that even after netting out the taxes as well as the depreciation of the currency, NRI investor will be better off investing in India, considering the kind of growth potential that it offers. Also, the income tax compliances and assessments are now faceless, completely online, and quite easy to manage. Another important deterrent which is there in the minds of NRIs from participating in this Amrit Kaal is repatriation of funds. Repatriation now is a very simple and a seamless process, and if the funds have got origin outside India, then there is no procedure which has to be followed, and the entire amount can be easily repatriated to the NRI bank account, as we discussed in the earlier part, in a very seamless manner. And even if those funds have got origin from Indian sources, there is a procedure which has to be followed, and it can be easily remitted to the extent of $1 million per NRI per year. This is something which, this is a notion which is still there in the minds of several NRIs, that whenever he or she wants to invest and transact in the Indian financial markets or real estate, it is necessary or it is pertinent to visit India, which is not true. All these kinds of activities which are pivotal for participating in Amrit Kaal can happen remotely through digital means. Starting with banking operations, the entire process, right from opening a bank account to carrying out all kinds of financial transactions, banking transactions, and someone can think of can happen seamlessly in a digital manner through the online banking interface. Also, all kinds of financial investments activities into any kind of asset class that someone can think of, mutual funds, PMS, other fixed income options, is something which can happen seamlessly through the digital modes of interaction outside India. Real estate is also something, the buying and selling of which can be executed outside India. There are certain procedures, legal processes which needs to be followed depending upon the state law, relevant state law, for carrying out these real estate transactions. But in a gist, the entire real estate transaction activity can happen outside India. As we discussed earlier, all the income tax compliances and assessments are also digital and can happen remotely in a very convenient manner. Depreciation of currency is a very concerning aspect for several non-resident Indians who are looking for investing in India. This is because there is an erosion in the value of the INR vis-a-vis the USD or the AUD or the GBP over the years, which is why the investor may lose out on the value of the investment. If we look at the depreciation of currency in the last 7 years, from 2016 to the present date, then there has been only a meager around 3% depreciation on a CAGR basis in the last 7 years. The depreciation of currency happens on account of two major factors, as highlighted. One is the inflows and outflows that happen from the foreign markets to the FII and the FDI flows. And second is the inflation differential between the two economies. If we look and analyze each of this in depth, then looking at the first aspect, the foreign fund inflows have now started beginning to improve quite a lot. If we look at the FII inflows in the past few weeks, they have turned to be positive as compared to what they were earlier, and which is why there has been a lot of further demand for the currency, which will boost and strengthen the currency and reduce the amount of and the chances of depreciation in the coming times. Also, with the reduction of the rates by the US central bank, there will be greater inflows of FIIs into the Indian markets. It is also important to note that several FDI projects in India have been announced of late, may it be in manufacturing or infrastructure or any other sector, in a structured manner, which will also result in a lot of FDI inflows in the economy and will give a boost to the currency and reduce the chances of depreciation. Now, if we look at this rule of thumb, which is the inflation differential between the two economies, which is India and US, we can see that the Indian inflation is definitely greater than that of the US, which is why we can surely expect that the depreciation of currency will continue. However, if we look at the difference, then it is hardly 1 or 2%, which indicates that the depreciation will be in a very calibrated, in a tapered manner in the coming times. A lot of NRIs do invest in India and also plan of regularly different kinds of avenues of increasing their investment exposure in India. But what we have observed is that not many of them follow the key principles which are to be followed while investing in India. Number one being asset allocation. Asset allocation, it is between different asset classes, which is real estate, equity, fixed income, depending upon the kind of objectives that the investor has in mind, is extremely important and has to be followed very importantly. Second is the risk mitigation. Every investment has got some kind of a risk, which is the currency risk, which we discussed recently. Also country specific risk, which is there. And every asset class has got its own pros and cons, which needs to be borne in mind. So this risk has to be mitigated to the extent possible. Capital protection is also another important principle, and it is extremely important to preserve the capital and whatever by investing into fixed income investments or some other assured kind of a capital protection strategy. And the returns from this capital protection strategy can be invested into growth oriented assets or investments. Goal based investing is something which most investors recognize and also try to formulate their investment basis these goals. But something important to note is that these goal based investing has to be dynamic and agile, because the financial goals might keep changing at different stages and ages in life, which is why it has to be dynamic and a constant process. This brings us to the end of the second part of our session. A very important topic in limelight of late has been the GIFT City, and this is one of the highlights of this Amrit Kaal era that we are all into. So we thought of introducing this through a panel discussion by inviting esteemed panelists with us who can share their views through their relevant expertise in those particular areas. We are fortunate to have two esteemed panelists with us today. Mr. Amit Doshi is the Deputy Vice President of HDFC Asset Management Company, and he is a veteran in the asset management industry since last more than 2 decades, having faced several different kinds of the entire journey that the Indian equity market has witnessed all this while. And we also have Mr. Anshul Jain, who is the Vice President and Head of Kotak Bank's GIFT City arm. He has a very vast experience of dealing into GIFT City related product offerings, as well as different kinds of stakeholders who are involved in the GIFT City. Before we begin this question answer session with the two esteemed panelists, I would like to give a brief idea, an introduction of what this GIFT City is all about. This GIFT City is India's first international financial services center, developed exclusively with the purpose of boosting financial services activity in this uniquely carved area, which is indicated in the map, with the vision of making this area like a global financial services center, just as a Singapore or a Hong Kong or Dubai. Now, looking into the different legal intricacies of this GIFT City, the GIFT City area is a non-resident of under FEMA. So, none of the exchange control regulations that are applicable in the rest of the country are applicable in this special economic zone, which is carved out in the GIFT City. However, other laws such as the Indian income tax law, as well as the Companies Act and other business laws continue to apply. There are several important concessions that are laid under the Indian Income Tax Act for investment and financial activity in this GIFT City, which we will discuss further. So this GIFT City, to summarize, is into split into two different parts. One is the domestic tariff area, which is the area outside this SEZ, which is in which all the kinds of regulations are applicable and there are no special concessions which are given. And another is the special economic zone, developed to promote all these kinds of activities which are mentioned in the slide, out of which we will be discussing today and focusing on what is relevant to an investor from his or her own perspective, to asset management, which is investments, and banking. So other kinds of activities, may it be manufacturing, trading, or whatsoever, do not have any kind of relevance with GIFT City. It is purely with the objective of developing and boosting financial services activity. A very important initiative that the government has taken for GIFT City is by setting up a centralized and a unified authority which governs all the laws and everything, all the clearances, all the processes that are there in GIFT City, which is the IFSCA. So all the kind of regulators are subsumed into a unified authority, which becomes quite convenient for the investors to participate. Now let us move forward with the question answer session with our expert panelists.
Thank you, Daxesh Bhai and Rajit Bhai, for the detailed insights on how an NRI can leverage their financials in India. Now let's move on to the second part of the presentation, which is based on the panel discussion with the financial experts on Gift City with Mr. Daxesh Kothari and CA Rajit Kothari. Over to you, sir. Thank you.
Hello once again, everybody, and a warm welcome to our panelists, Amit Bhai and Mr. Anshul Jain, being available at such a late hour for the benefit of our clients and all those interested persons, non-resident Indians who are located across the globe. So to start with, I have a question for Amit Bhai, who is on the asset management side, is that Amit Bhai, what could be the investment opportunities which could be available to non-resident Indians now when we have got the Gift City quite into operation, and these opportunities and products from the standpoint of the underlying assets where the investments would be made, the regulatory aspects and the taxation aspects of it. Please, sir, throw some light on that.
Yeah, good evening. Thank you so much, Daxesh Bhai, Rajit, to take this efforts and fortunate enough to be a part of this elite panel. And we welcome all our global investors on this forum. So, Daxesh Bhai, I would like to highlight 2-3 points where the purpose of Gift City will be solved. One of them is a simple regulations and specific compliance where investors feel that India had some issues, and because of the Gift City, I think you'll be able to easily invest into Indian markets, to take exposure of the global markets, to invest into private equities, Indian equities, listed, non-listed, and other instruments and the financial assets. So Gift City will be a hub wherein, as an asset manager, I'll be able to introduce many products with my global partners and global alliance, with the help of intermediaries like you who can reach out to the global investors and non-resident entities, and they can invest. I'll give you a very simple example that the product that we are going to launch in next couple of months, mostly in January and or the February. Let's say somebody wishes to invest into the listed mutual funds or the equities in India. Now, one of the route is, they can invest directly into the mutual funds by way of doing a KYC, wherein, PAN and other formalities to be done, opening an NRI account and, investing. Through Gift City, I think formalities are very, very simple. No need of PAN or Aadhaar, no need to have any NRI, NRO account. Straight away, specifically from their bank account, they can do a swift transfer to our funds and products via intermediary like you, wherein you'll be taking the responsibility on some processes and the compliance part, and they'll be straight away investing through a feeder fund to our mutual fund schemes. So very, very simple process, and this products will be live again maybe in next 30-40 days. This is one part. Now, the interesting part is that the product will be category 3 AIF, wherein an investor who will be getting a capital gain by investing into this products over a period of 3, 5, 7, 10 years the capital gain for which they need not to pay any tax in Indian soil. Basically, in the Indian regulation, as per the Indian regulation, they are not going to pay any tax. So this is the second one. And the third one is, going forward, we may be launching another product wherein, investments into private equities, unlisted, global, so mix and match, wherein, they'll be getting a complete bouquet of financial assets in couple of products. And the treatment of tax, treatment of processes, and the way investors' journey to be, we call it should be very smooth, will be most beneficial routed through the gift city. I would like to summarize in that manner.
Are these products specifically targeted to particular jurisdictions where NRIs are located? Say they are targeted to certain jurisdictions where these products would be best suited to. Anything of that sort is up in the mind of the asset management companies when they roll out these products?
Absolutely, absolutely. So two points. One is the products wherein, the global interest of the investors, and we feel that, there is a demand from different segment of the investors and the different geographies where, they feel that, they want to be a part of the journey of India Amrit Kaal for next 10-15 years. This is one. And second is, yes, we'll be very mindful in terms of launching the products basis on the geographical regulations, compliances, and taxes. So that, a person staying in US and a person staying in, let's say, Australia or the Middle East or the European market, and the requirement of the tax compliance, the legal compliance, the risk management, so we'll have a bouquet of products targeted to the different investor groups basis on the geography and as well as the compliance. So of course, yes.
Okay. Say so many of the resident Indians, they have an opportunity of transferring money outside of India under the liberalized remittance scheme. So to the extent of, as we all know, to the extent of $250,000 per person per year, monies can be transferred outside of India by resident Indians. And in so many cases, these monies are transferred outside of India for, say, making or building up a kitty or a corpus outside India where somebody would like to relocate or maybe support a relative who is located outside of India. So are there any products for persons who are technically resident Indians but have got assets, foreign assets, which have been created out of these remittances? Are there products which are a part of the gift city offering?
Absolutely, absolutely. So one of the objective of gift city is to have a central hub where, maybe if you can understand in terms of the Singapore or the Hong Kong, which, they've established a central hub for all the global transactions. So objective of setting up the gift city, one of the objective is to have the similar kind of setup wherein, Indian resident, a future for the future planning or for any of the purpose wishes to migrate or, to invest through LRS and kind of remittance opportunities. Yes, the products are in making, and you'll be surprised and amazed to see the products and the offerings by the asset managers and the other players that they globally tying up with the specialized managers to manage those assets and the products within the India itself. So that will be a big opportunity.
Right. Are there any requirements or something which is lacking on the regulatory side, which you would be looking forward that after these things are in place, we'll be able to conveniently roll out more products? Is that something, or the regulatory part is quite in place, and you will be able to roll out whatever products which somebody can think of, or we can which can be envisaged by the asset managers?
Yes, that's a very pertinent question, and we all are surprised, and everybody is looking at the reforms that has been done in last 5-9 years. So, regulator and government is very forward looking, and we are very, very, very happy and pleased that government is taking initiatives on the positive aspects of rules and regulations and the compliance part. So in fact, it's the government initiatives and the regulator who they are giving us the opportunity to launch the products. So
Okay.
that's very, very favorable.
Right. Okay. Thank you. Thank you,
Pleasure.
Amit Bhai. Right. Now, some questions for our second panelist, Mr. Anshul Jain, who is the veteran on the banking side and who heads, as Rajit said and described, the person who is heading the IBU unit in the GIFT City. Mr. Jain, what could be the products which are rolled out by the Indian banks, which are suited for the non-resident Indians, and where there is a distinct advantage for coming to the GIFT City and investing or transacting in respect of those products?
Yeah. Thank you so much, sir, and thanks to all our esteemed clients who have joined today. So as Mr. Kothari mentioned in his earlier slides, and also Mr. Amit mentioned, so a lot of AIFs are already there with different structures. So 50 plus AIFs are already operating out of GIFT City. Now there are 2 to 3 AMCs which have set up, their shops at GIFT City, looking to, leverage these products and leverage these investments. From banking side also, and any NRI who is looking to invest into deposits. Okay, so clients can come and park deposit with GIFT City. So in the earlier slides of the presentation, Mr. Kothari did mention on the FCNR deposits, okay, which are as good as the safest and capital protection plan. And a lot of clients do that they park funds into deposits and look out for opportunities for investment whenever the market is right or the dollar rupee rate is favorable. But if you have to earn interest on an FCNR deposit, it has to be for a minimum period of 12 months. But with GIFT City, since it's an offshore banking unit and it is it is outside the FEMA purview of FEMA of India and RBI. So even deposit which are parked for a shorter tenure can earn interest on it. So if any of the clients are looking for for a smaller period, a larger amount or a smaller amount to park in deposits, then funds can be parked at GIFT City even for 30 days, 60 days, 90 days, and still they will give you dollar returns. Secondly, if you will see the deposit rates, which probably clients in US would get at a dollar, would be not more than 4.5, 4.25 for a year. But at GIFT City, the interest rate is as high as 6%. Some banks are even offering 6.1% on these deposits. So higher interest rate, plus for shorter tenure, also there are instruments available. Plus lending is available against these deposits. Even if any of the clients have their businesses and they have surplus funds which they are looking to deploy for short-term investments or long-term investments, purely into deposits, it can be parked with even for entities, for their companies also. Banks can accept those deposits. We can lend against those deposits. We can even lend, so one of the businesses which IBUs does is a lot of lending. So they'll lend to a lot of offshore corporates from GIFT City. So that is also, happening. So in true sense, the idea of GIFT City, which was to bring offshore onshore, these are steps towards it.
Okay. So if, as you said, that monies can be parked into the GIFT City and by the non-resident Indians, and they can stand and move back and forth from that parking which is happening in the GIFT City. So what could be the cost of moving that monies which are parked in the GIFT City to India, where the ultimate destination where somebody would like to apply in terms of investments or use in India? So what could be the costs involved in that, transferring money from the GIFT City banking unit to India?
Yeah. So I represent Kotak Mahindra Bank, and as far as Kotak is concerned, we don't charge anything to our clients, from moving funds from Gift City to India. Though there is a cost involved, but at the bank level, we have taken a decision that we will absorb that cost, because we also think that this is a story which probably India is looking at 5 to 10 years, and they are looking to become the biggest IFSC, and that the idea of the government and the way investments are coming, and the direct focus both from the PMO and Ministry of Finance is definitely there. So, looking everything and the larger picture in mind, then we have just waived off all the costs, so there is no additional cost which client would have to incur.
Okay. You talked about the leveraging which can happen out of the gift city where you would lend funds. So, are assets which are located in India, which can be used as something which could be a mortgage or a kind of a security against which lending can happen in the gift city and vice versa?
Yes. So, property, if it is at India, or even there are any investment portfolio in terms of mutual funds or equity or deposits, anything which is parked at, let's say, India or globally across, anywhere globally, we can mortgage those deposits or investments, and lien mark those deposits and fund anywhere in it, anywhere across the world. So if the client is, let's say, based out of US and they have some investments in US and in India, a mix of both, and they are looking to raise some funds at US, we can do that.
Okay, that's very interesting. That's very interesting. So, of what I understand from what you're saying is that if I have a portfolio of a certain amount of money in India, I can use that portfolio to be leveraged through the gift city route straight away, and I can use those funds maybe outside of India for my whatever reasons.
Correct.
No? So at times, what happens is that non-residents liquidate their portfolio for some kind of a reason or a purpose. Here, they can quite borrow in foreign currency, repay in foreign currency without any consequence. Is that right?
That is right. Only restriction from Reserve Bank of India is that this money has to be earned outside India. So it cannot happen that client earns money in India, and let's say in NRO deposits or NRO the money funds are lying, and we our investments have happened through NRO, and we use those funds to fund overseas, because then it defeats the entire purpose of RBI's restriction of USD 1 million.
Okay. So, whatever are the investments, if they are NRE based investments, then we can borrow, right?
Yes.
Is that right?
That's
So
right.
they are basically repatriable money.
Yes.
Okay, right. And say, as I was talking to Amit by the earlier speaker, as to the kind of people who are resident Indians, and they are transferring money under the LRS to a jurisdiction which is FAMA jurisdiction, which is outside of India, which is our gift city.
Correct.
So there, as we all know, is the 250,000 US dollars. So if those monies are parked in the gift city, so technically a resident Indian would be operating a foreign bank account in the gift city. Is that possible?
Yes, definitely that is possible, sir. And yeah, if you will see, RBI relaxed this norms for Gift City 6 months back. We have been seeing a lot of interactions and a lot of inquiries from clients. It is just that there are the investment opportunities at Gift is very limited. But probably in next 3 to 6 months, what I hear from various stakeholders and regulators, there are 50 more funds coming just to attract this LRS money, so that they can also participate into any of the global instruments they want to. So they will have access to bonds, they will have access to different PMS structures, they will have access to different geographies, equities, mutual funds, lot of other things. Still, there are 3, 4 funds which are already launched who cater to these LRS money to invest globally. Because LRS money, if it is coming to gift, it cannot be invested into an AIF who invests back into India. because that is not allowed by Reserve Bank of India, and it is considered as round tripping of funds. So any fund which is investing globally, a client can open a US dollar account with Gift City. Funds up to $250,000 as per LRS limit can come to Gift City, and it can be invested globally. Now, further, RBI has also relaxed some parameters on family investment funds and through OPI route, where 50% of net worth client can send funds. Still, we are clarifying the last leg of, awaiting the last leg clarity from both the regulators. But what I hear from the ground, the first two approvals could come as early as before 31st December. And once those two approvals comes and they're activated, there are already 15 to 17 applications pending with regulator. And I think 50 to 100 more clients awaiting that as soon as the first couple of them are approved, they will also put up their applications. So clients are even very excited about through FIF route, through OPI route, investing in Gift City.
Okay. And just by way of repetition, so a resident Indian can open an account in an IBU, which is located in the Gift City, in a foreign currency denominated banking account in the Gift City. Is that the position right?
That is absolutely right, sir.
Okay, that's very interesting. So, if somebody wants to transact, hold funds in foreign currency, they need not transfer it in any jurisdiction just like that. They can hold that bank account, which is a foreign currency account, just nearby, which is in our Gift City. So
Correct.
that's very interesting, and it's very important for anybody to transfer money, hold it, and invest and apply it at the right point of time. A lot of insights. Any other kind of opportunities which you see from the banking side, which are not in the common knowledge or understanding of the people at large, which is available through the medium of Gift City?
Yes. Sir, I will just like to highlight one thing here. So NRI clients would have already access to global funds, global stocks through their current financial advisors or current brokers. Let's say anywhere. Let's say if they're in US, they would have their US brokers through which they can invest. But the way they are planning to develop Gift City is so it will become the largest financial hub of the world. And the primary objective is to reduce the cost as low as possible. So probably not today, but in next 6 to 12 months, even if the client wants to invest into a US fund, they would probably choose the route of Gift City because of its cost and easy regulations. So very, very, client friendly and business oriented regulator we have who are always approachable, very, very forward looking, full backing of Indian government. So this will become really a very, very large hub from investment perspective. And anything which is, India or Indians, whether they are resident, non-resident, Indian corporates or corporates of our non-resident clients, they want to do any transaction, we would be able to, cater to those conditions, whether it is on the investment side, lending side. So we already, the entire books of, there are 26 banks already at Gift City. The entire book is more than $50 billion already. Okay, and most of these activities have happened since 2021 in last 2 years. So the books have become 5 times. And the way regulator is seeing is that by next 3 to 4 years, it would become 500 to 600 billion dollars, which will be a very, very large portfolio of across all the banks. So that's the infrastructure and that's the way it is growing.
Right. So hearing both of you, we really feel that the Amrit Kaal for India is very much in the offing, and India is going to be on the basis of whatever actions, and that includes the Gift City opportunity, be a significant player in the financial landscape in the world at large. So that sounds very interesting, and thank you so much for a lot of valuable insights. And we'll take it forward, and I hope and I'm very sure that there will be at least a few questions from the participants on the GIFT City side, which is an interesting, very interesting topic, and where a lot of interest is developing day by day. I will hand it over to Rajit to give some insight of a family investment fund opportunity in the GIFT City. And then we'll take up eventually the question answer session.
Let us look into this option, which is now available in the GIFT City, a very interesting avenue, which is Family Investment Fund. This FIF is a kind of a structured family office to manage the entire investment portfolio of a single family. The way it works is that a single family can pool funds into this particular structure, which could be through their own funds or through entities which they own. And the minimum corpus has to be at least 10 million US dollars, which has to be pooled within a period of 3 years. And this corpus of FIF can be invested into a broad set of options, which could be listed, unlisted stocks inside, outside India, as well as other alternate kind of assets that have been mentioned in the slides. Now, what is the advantage of this GIFT City, of this FIF route in GIFT City, is that one can, of course, leverage from banks, as we discussed earlier as well, from in the GIFT City and invest. And also there are a lot of tax concessions, very attractive tax concessions, which are available to these FIFs. Now, that if we look into these advantages, then the entire income tax that is on, which arises on the different transactions of into investment incomes of the FIF corpus is tax-free for a period of 10 consecutive years out of the first 15 years under this section. And also, there is no GST on the services which are received by the FIF from any particular service provider in the GIFT City. One thing to bear in mind for the FIF corpus creation is that the LRS limits for resident Indians, not talking about the non-resident Indians, which is 250,000 US dollars, will be applicable. So that is the extent to which someone can pool in funds. But if there is some other entity which has been incorporated in India, then these limits could be greater depending upon the size and the amount of corpus that the particular entity is holding. Just a general disclaimer that all the views of the speakers, Mr. Daxesh Kothari and myself, on the earlier part, as well as of the panelists on the panel discussion, were personal in nature, and neither the speakers, panelists, or the company does purport to give any kind of professional financial advice. And wherever there were some kind of references which we have used, we have given the relevant links and source of the information. This is the entire set of events that we have planned for this conclave, the two virtual events which were scheduled today, and you will soon receive the entire YouTube link of the session within the next week. Also, we have planned several physical events across the state of Gujarat. So we would be more than happy to welcome you there if anyone can make it. Thank you so much to all the participants from different parts of the world to spare in their valuable time on this weekend and being available for this knowledge sharing initiative. We hope you had a great time, and now we are open to answer your questions.
Thank you so much to everybody who participated in the Zoom meeting, and a special thanks to both the panelists for making themselves available and throwing a lot of light and valuable insight on the opportunities in the GIFT City. Thank you so much. We'll take up questions now, please.
Okay, thank you. I'm going through the questions which have been posted in the chat box, and we'll be taking one by one. So here we have got quite a few good responses from the participants, and would like to start with a question from Mr. Amish Vipakar. And Amish Bhai is asking that he would like to understand in detail the LTCG, which is long-term capital gain from the investment through NRE or Forex, exempted under Section 115F on investment for 3 years in specified assets.
Okay. So under 115F, the provision says that whatever is the long-term capital gain which is generated, and the investment of the shares which have already been made is out of the funds from the NRE account or remittances, they qualify for this deduction or exemption. Under this exemption, if the proceeds, the entire sale consideration is invested in another specified assets. So specified assets as defined in the section are shares of Indian companies, deposits with the banks, and also government securities. So if the amounts which are received by way of sale consideration are invested in any of these these three specified assets, again, then these amounts, the capital gain on the asset which has been sold, which is shares of Indian companies, would become tax-free, and that asset, which is the new asset, has to be held for a period of 3 years, and leverage or borrowing can be made against this asset. So this is what is the provision which we were talking about.
Okay, thank you. Another one is from Mr. Kishore Thakkar, and he is asking for when transferring funds from NRO to NRE, what sort of taxes are applicable if we have assets or immovable property with the foreign money paid through NRE.
Okay. If there are monies which are in the NRO account, the only requirement to transfer under the $1 million scheme is that appropriate taxes in respect of the monies which are standing to the credit of the NRO account has been paid. So if, let us, for instance, understand that these monies are received as sale proceeds on sale of immovable property. So if I want to transfer that NRO money, which is a part of the sale proceeds of the immovable property, into the NRE account or remit outside of India under the $1 million scheme, then I need to pay the taxes which are due on that amount, and not a specific tax to transfer. There is no charge, no transfer fee or transfer tax from NRO to NRE. The only requirement is that if you are transferring the money from a non-repatriable to a repatriable account, please pay the taxes which are due on that money in India, if at all they are. Say maybe it's a gift received from a relative, then there is no tax which is due on that money. Then transferring of this money can be done by formalities, which is very simple. Respective forms have to be submitted to the bank, and the bank would transfer that money from the NRO to NRE account.
Okay. Another one is from Kishore Bhai, and that is regarding investments in a portfolio management services. And he is to understand the benefit of investing into a PMS, and what are the risk factor, and what sort of return he can expect by investing into it.
So, talking about the advantages of investing into a PMS, can we have that slide? So basically, PMS is a portfolio of diversified stocks, equity shares, and the advantages of investing into a PMS, if we look into it from NRI's perspective, is primarily that there is no notional tax as far as USA is concerned. Now, talking about the other advantages, if the NRI is not from USA, then the primary advantage is that there is no impact of inflows and outflows from other investors into the entire portfolio, because it is a unique and a segregated kind of a portfolio with a separate demat account and own shares owned by the particular investor. So that will not have any kind of impact. Looking into the other advantage, the kind of regulatory restrictions that are there in a mutual fund are greater as compared to a PMS, because mutual fund is a retail kind of investment option. So there are greater number of restrictions. While as in case of a PMS, there can be a concentrated portfolio which can be built, since there are less number of regulatory caps in terms of sector specific caps or stock specific caps. So the amount of risk could be a little on the higher side, but the amount of concentrated portfolio and the return that someone can expect can also be of a better, it can be better.
Okay, thanks. Another question is from Mr. Amish Vibhakar, and that is regarding the preferable rates when transferring the money to India. So I think it is related to the gift city, remitting funds to the gift city, and what would be the preferable rates he can expect to get, and how does it work actually?
Preferable rates. So I didn't get the question as to what is the kind of, it all depends upon whatever is the prevalent rate at that point of time. So preferable rates, I think I'm
Okay.
not clear with the question.
Should Abhish bhai, should I unmute you so that you can directly interact with the Daxesh bhai? He has mentioned that it is related to the exchange rate. Let me try unmuting him. Let's see if he can interact with you directly.
Hi, this is Amish here.
Okay, great.
Hello, Amish.
Thank you for all the insightful information that you are imparting today. It's really great. My question here was quite simple, that if we are transferring money down to the city, gift city, then what kind of, if you're transferring from one bank to another bank, generally there is an exchange rate that is given out by the bank that we are transferring from here. But would there be any advantage where if we transfer down to gift city, there would be some sort of a preferential rate that would be provided?
I think Mr. Jain would be an appropriate person to address this. Please,
Yeah.
Mr. Jain.
Sure, thank you. So, Mr. Amish, when your account is with Gift City, it is a foreign currency account only. So it is a dollar account only. So the forex rates, so when you are sending funds, let's say from US to Gift City, it is a dollar to dollar transaction. And also when it is moving out of Gift City, it will move out of Gift City in dollars only. So there is no exchange rate risk or any exchange rate scenarios which will come at Gift City.
Except for the bank charges.
Except for the bank charges, correct? Which also I mentioned that we have completely waived off.
Okay. So, but my bank would still charge me over here compared to what you would receive over there.
Yes. Yeah. So your bank in, let's say if you are, may
I'm
I
based
know?
out of Dubai.
You are in?
Dubai.
Dubai. Okay. Yeah. So your Dubai bank may charge a fee depending on your relationship with the bank, $15 to $40 per transaction. But when it is received to Gift City and when it's moving back, let's say to your UAE account or to your NRI account in India, there will be no charge.
Okay. Thank you.
Yeah.
Yeah. Another one is the question is from Mr. Rajesh Kothari, and he has mentioned that can funds transferred from NRI account to Gift City account for investing in global equity and funds market, transferring funds from NRE to Gift City and then investing to abroad.
Yeah, sir, if you mind, I'll take the first half of the question. NRE
Please.
account to Gift City, yes, it is fully repatriable. Funds can come here and get parked into a US dollar for as long as you want. For investing, I think Mr. Amit we do have option, but I think he will be the right person to give you a few insights on that.
Yeah, Amit bhai, please.
Yeah, that's the correct interpretation by you, Rajesh bhai. Yes, the very purpose of the Gift City is to have a global exposure to the NRI clients through this mechanism that you bring in the foreign currency, open an account, and then you can have a global exposure. Yes, so answer is yes, absolutely. And products are in making, so that's one. And second is you'll be getting a lot of expertise. So being an SDFC asset management company, I have an expertise to have 21 years of expertise in Indian market, and I'm developing my relationships across the globe to have foreign partners with me to manage my clients' global money and to have an exposure into global equities also. So answer is yes, absolutely, that's possible. We can do that, and you will see a lot of offerings.
Okay, now another question is from Mr. Malay. I believe Mr. Malay Shah. So I would request if I can unmute him and he can directly interact with you, so that we can better understand the query and reply to the same accordingly. So, sorry, let me just unmute him.
Hello, can you hear me?
Yes.
Yes, very much. Malay, hello.
Wonderful. Thank you, team, for wonderful explanation and all the details. So the question is regarding the investment vehicles that Rajit was talking about, right? So, of course, the traditional way that we invest from, let's say, USA in mutual funds in India, that's one way, and the other two options were kind of new for me. Now, of course, the gift city option is also new for me. So to consider all the different options, the two questions that first have come to mind is what about the risk factor, and the second is what about the ease of management remotely while sitting over here in USA. And the thing is that now that more concern is on the safety aspect rather than the high risk high reward category of investments, right? So if we want to go in that way, which options would be the better options?
So, as far as the mutual funds are concerned, which we discussed, are the most simple, cost-effective ways of investing. And the kind of risk which is there is definitely market risk, which we are exposed to. So that is something which is inevitable and which is there in any kind of equity option, may it be a mutual fund or a PMS that we go about. So yes, we would be exposed to market risk, but we are not exposed to credit risk in the sense that our monies may not go down the drain, because we should look at what are the underlying assets. These monies are invested into all blue chip and other reputed companies in India, which have got a very good financial track record and well-being. So as far as that risk is concerned, we feel that the kind of risk is quite minimal. And over a period of time, since the Indian economy is expected to do in a certain pattern, we can expect a good kind of return from it. So yes, if we look into the risk aspect, then mutual funds carry the minimum amount of risk. The other equity offerings, which is the PMS, the risk can be on a higher side. And the third option, which I mentioned, is of the unlisted stocks. The risk can be on the highest side as compared to the other two options, because the company is not listed and there is no certainty in terms of the liquidity aspect as well. So this is the gradation of the risk, and also the return is on the same pattern, meaning the multi-bagger return that we can expect is from the unlisted stocks because of the kind of opportunity that it offers. And the lower, as compared to that, the listed options may not be able to have that kind of a multi-bagger kind of a return in the coming times. So that is the gradation of the risk vis-a-vis the returns.
And the idea, Malay, was of introducing all these products was that basically one can go for a asset mix, an asset allocation across all these products. So mutual fund can have its major share of allocation, and certain allocations can be in some other products which are of a different kind of in a risk return kind of a scenario. So that was the basic, to give a perspective of the different products which are on a different different risk return metrics. Please, Malay.
Wonderful. Great. Thank you so much.
Thanks.
So with this wonderful interaction session with all the participants, we are here come to the end of the presentation. And we thank you all for your kind support and joining us for this webinar. The recording of this presentation will be available on our YouTube channel, which is in the name of Ashutosh Financial. We look forward to see you again next year. And we also be happy to see you in the physical event which have been planned for this season across the location of Gujarat. Thank you so much. Good night. Take care.
Thank you. Thank you, everybody. Thanks.